Welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. Budget season is upon us, and as always, expectations are running high as this is the Modi government's last budget before the general elections. While Finance Minister Arun Jaitley will only be presenting a vote on account on the 1st of February, the middle class hopes he will ease the average taxpayer's burden by offering more deductions and more exemptions. So what is the personal finance wish list for Budget 2019 looking like, and what are the areas where investors can perhaps hope for some cheer? Joining me to discuss this are Kuldeep Kumar, partner PwC, Homi Mistry, partner at Deloitte, and Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth. Thank you, gentlemen, so much for being with us on the show. Plenty to talk about. Taxes, something we all have to learn to live with, but we all can do with lower level of taxation. So, let's get some first thoughts in. I think the big, war cry of sorts, Feroz, this time around is an increase in the threshold itself. I think everybody's talking about that from 2.5 lakhs. The optimists are saying it could go to 5. Some people are saying 3.5. But Homi, first thoughts, open it out for us. What is sort of your first glance or first thought with respect to this year's vote on account?
Yeah, so what I feel, Surbi, that there's a good chance or possibility that the exemption limit for all taxpayers would go up. So, for example, currently the slab is up to 2,50,000 rupees. You don't pay any tax for a person who's under 60 years. So, there's an expectation that amount may go up from 2.5 lakhs to 3 lakhs. Correspondingly, the exemption limit for a person who's 60 and above, the limit is currently 3 lakh rupees. So, there's an expectation that should also go up by another 50,000 to maybe 3.5 lakhs. And lastly, there's another slab for people who are very senior citizens, who are 80 and above. There's also an possibility that the exemption limit for them may increase from 5 lakhs to 5.5 lakhs. Okay,
all sounds wonderful. Music to the ears. Kuldeep, let's get your initial thoughts as well. Are you expecting similar changes in the basic exemption limit?
No, absolutely. If you will see the trend, the way this government has been walking the tax path, actually, the richer has been, taxed more. Be it, those who were earning between 50 lakh and 1 crore, they were slapped with a 10% surcharge last year, or be it the capping on the claiming of the loss from house property to 2 lakh. So, what is going to be in this budget is actually for the common man, where taxpayer at large benefit from that, and that can very easily happen by raising the basic exemption limit and also raising the ATC deduction limit from 1,50,000 to 2 lakh rupees. And you know that this ATC deduction, it comprises a lot of investment, even expenditure. So that actually automatically get consumed without an additional effort or push from the taxpayer to save more to save tax. But I think that with a lot of choices available, this limit may go up. But also don't get surprised, actually. Last year it was, if it was for the senior citizen, this time why not the women taxpayer actually? And for them, the basic exemption limit may be raised, from 2,50,000 to 3,25,000 rupees. And this is more, in the offing because of the GST or the other demonetization, the little bit of inconvenience or little higher in cost of household expenses. I think that could be a good opportunity to cheer them as well.
Well, that would be very interesting, though. I don't know if the government would want to do this along gender lines, but I completely take your point. I think that first slab, the threshold limit, I think that is the big talking point. Feroz, maybe that is the big headline. If it comes through, it'll be a headline. If it doesn't come through, that'll also be a headline. But beyond just the first income tax slab, what else are you watching out for this year?
See, I think if you look at tax from a budget standpoint, there are two heads. One is on the income, the other is on investments. I think investments get lesser attention than income does. But the impact on your investment taxation will have a larger implication in the long run. So point one, I think if there is some increase in the limit, like we were speaking, I don't think it's going to be small limit changes. It's going to be a large limit change, which is going to be meaningful to make the headlines, like you said. From investment standpoint, I think they have just taxed equity, and I think that's not going to change. But on the debt side, as inflation has come down, at least the indexation number has come down to almost like 3 and 2.5 on the indexation benefit you get.
That is when you remain invested in a debt mutual fund for 3 years.
3 years, right? So what has happened is the indexation limit which you had, but the indexation provision has come down from 9 to as little as 2.5, 2.9.
Just because inflation has fallen so much.
Right? So that, I think they had eliminated one provision which went unnoticed, is that 10% without indexation or 20% with indexation. The 10% without indexation was removed from all debt mutual funds. I think that should be reintroduced. That's a wish list. I don't think it'll be the attention. And then I think the larger picture is the government revenues are going to go high in the long run only if they bring in inheritance tax, which is what our global peers are. Matlab, in the sense, US has in the range of 40 to 50% of inheritance tax, and there is UK, which is as high as 40-45% inheritance tax. Are we going in that direction? We are. So I think that's one thing that I'll watch out for. Maybe not now, but that's one more fear which you need to provision for and plan for.
All right, fair enough. I'm going to actually come back to some of these points on investments as we go forward in the conversation. But first, let's look at income, the deductions and the exemptions. Homi, as Kuldeep also mentioned, I think this unbundling of the ATC kitty, that's something that I think, men like you, women and men like you have been arguing for a long, long time. It is 1.5 lakhs right now, everything clubbed in, including your LIC premiums, your pension, ELSS, etc. If, the finance minister were to look at industry suggestions, how can this be perhaps streamlined better?
So right now, as you know, there's a lump sum of 1.5 lakhs, and there have been discussions, should we further increase it? Actually, the finance minister had made this limit 1.5 lakhs in the year 2014 when he first presented his budget.
Yes.
So at least 5 years have passed. And my feeling is that if he were to increase the limit, he may not necessarily unbundle it. It may still continue as being bundled. And there's expectation if it goes up, it'll go up to maybe 2 lakhs, or if you're lucky enough, it may go up to 2.5 lakhs.
Okay, fair enough. Kuldeep, your thoughts? And I'm leaving housing out of this for a moment. We'll come back to that in just a moment. And leaving NPS out, that's a separate discussion. But, in terms of hiking deductions, more exemptions, which are the sections that you'd look at where primarily there is a strong case?
I think, since this is a vote on account, I don't think they will try to make too many changes in this budget. I think he will only make changes which are easier and simpler to pass on to the taxpayer, and perhaps raising the ATC deduction limit, is one of the way to achieve that. And the other point, I would also like to make that the government has set up a task force committee, earlier this year to do the reforming of the Income Tax Act. I think all those changes, whether ATC deduction should stay, whether these deductions should stay, exemption should stay, or rather giving a higher basic exemption limit to the taxpayer at large. I think those kind of structural changes probably will come in the future. I think at that moment only those things will happen, which will go to everyone, common man, which will look big. And I think that government already indicated that they are in the slow goer. So why don't they would like to bat it well, actually?
Yeah, I remember that statement, right? They said that they can hit a 6 in any over first or the slog over. Well, let's see if sixes really come our way. Now, Feroz, I'm coming back to the point that you just made, and I think it's really important because last year was the important one. People had to learn to deal with LTCG, long-term capital gains tax again. 10%. What has been the first year experience? I mean, have clients gotten used to it? Are people utilizing that 1 lakh exemption limit that was given?
I think fortunately or unfortunately, it's clubbed with a year which didn't make
the market didn't do much, so no gains.
No gains, right? And the second thing which, of course, the FM did was gave a grandfathering provision. So people have not utilized that limit. Like Jan 31st values have been locked in from your taxation standpoint. Have those limits been breached? Almost 80% of the mutual funds are below that limit. So I was doing an analysis. So 80% of the open-ended schemes are below the 31st January limit. So you have not finished your grandfathering. So taxation has not hit us this year, but we have to learn to remember that and use that 1 lakh limit as and when it is there. The second thing which you have to note, irrespective budget or no budget, is that you should not change your portfolio till you reach that limit. Otherwise, you're increasing your tax liability. Dividend distribution tax has been here now from April 1st, even on equity mutual funds. But I think still there is lakhs of crores in dividend options. That has still not moved to growth options. I don't think the industry is propagating that change or the advisor community is doing that. So as a viewer or an investor, you're duty bound to move from dividend reinvestment.
So when you do that, when you shift your mutual fund holdings to the dividend option, to the growth option, is there going to be a one-time tax hit?
No, not currently, because there is not too much gain. So you're grandfathered. So otherwise, dividends which are coming, especially balanced funds, are on dividend reinvestment option or dividend payout option. In a growth option, you're at least deferring tax. And when you defer tax, you get compounding in your favor. And that's the only certainty in the business of investing. And you're letting go that compounding benefit of the tax component by paying it at source rather than paying it at exit. For long-term investors, it's an important point to acclimatize yourself and take those as decision inputs when you're taking actions.
Absolutely fair. So when there is a new taxation regime, you might as well get ready and learn to live with it, whether it comes to the taxes on the dividends that your mutual funds are paying you, or for that matter, the long-term capital gains tax itself. Homi, your thoughts on this? Now we've sort of had a year to kind of acclimatize. Are there any tweaks at all or any further clarification you'd need?
As even Feroz mentioned, that really people may not have really paid much tax because of this grandfathering provision, and a lot of the share prices were at their peak on 31st of January 2018. And so basically your gain is even if there's a gain, it's not much. You may or may not use the benefit of 1 lakh rupees. And even if there's a tax, it may not be very significant because the tax rate is only 10%.
Okay, all right. Gentlemen, now I want to understand provisions of this section 54EE or EC, I think. That's a little important. It does give the option of exemption from capital gains. If you've made capital gains, long-term capital gains, as long as you reinvest the proceeds in certain securities, specified securities, you can claim an exemption. Now, Homi, help us understand this, because I thought this really didn't apply to shares. This only applied to physical real estate, and that too with that 50 lakh cap. You could reinvest gains up to 50 lakhs. I think the securities were bonds issued by entities like NHAI, REC. So is this how this provision is being interpreted? Are you expecting any changes?
So basically, there's a section called 54EC. And in the past, that if you had any long-term gains and you invested in these specified bonds of NHAI or REC, you could claim a tax exemption up to 50 lakh rupees.
Correct.
It could be for any kind of long-term specified asset that you had sold and you earned a long-term gain. Last year, the government has restricted the benefit, and now only if you sell land or building, which is long-term in nature, then you have to then only you can get the benefit of the exemption if you invest again up to 50 lakhs in these NHI or REC bonds. And the other catch is you've got to keep these bonds not for a period of 3 years, which was initially there. You've got to now have it invested in these bonds up to 5 years.
Okay, so these were the changes made last year.
Last year.
And this is 54EC. Now,
Yes.
what is 54EE then in that case?
So 54EE is another section which was introduced a few years back. Basically, there also if you had long-term capital gains on any asset and you invested the money in certain notified units of specified funds by the government before April 2019.
Okay.
And capital gain exemption up to 50 lakh rupees was available. So far, no such units of any specified fund have been notified by the government.
Okay.
So one can't really make the use of this provision currently.
So this kind of ties in pretty well with some inputs that I've been picking up from the mutual fund sector, because I think the argument, Feroz, that they're making is that allow mutual funds, equity mutual funds, to get the benefit as well. If someone is willing to lock in the proceeds or the gains for at least a period of 5 years, means he is a long-term investor, then allow them to offset capital gains from a previous investment. So I don't know if this kind of makes sense, but any further thoughts you'd like to add on capital gains?
I think it makes perfect sense, Rabi, what you're saying. If real estate reinvestment with a certain clauses can give you capital gain exemption, and the other growth asset is equity. Why shouldn't equity? Because equity also get that benefit. Earlier, there was no long-term capital gain on equity. Now that you've introduced long-term capital gain, you have to also provision for what exemption provisions which you will allow a person after making the money. I think that will only happen after we progress in this journey of long-term capital gains for long enough, which has been there in real estate forever, as much as I know. So the point one I'm making is it is very wise to have both the growth assets, real estate and equity. And second is all our retirement savings are largely being pushed towards debt, which strategically is not right for an investor. Now, if you see ATC, you have 7, 8 debt options and you have one equity option, which is ELSS.
Yeah.
So that's why I'm very excited about NPS being included in ATC. Because even today, if I'm using several other instruments under my ATC, I would stop them except the involuntary ones like in EPF, right? And use that for my provision of NPS, because NPS allows me to invest in equity funds with minimal cost. So point one, of course, what you're saying makes so much sense, but I think it is a little way ahead. Point two, I think you have to be conscious under your ATC what portion of your money is going into debt and how much is going into equity, which should just be the opposite. 80-90% should go into equity and 10% should go into
And I think it'll be a path-breaking reform if they allow some changes within NPS, because I think the current maximum equity cap is 50%. So if that can be hiked, if you have the risk profile, if you have the right age profile, if you want to invest, let's say 75% of your retirement money in equity, why wouldn't or why shouldn't that be allowed? Maybe that's a thought that the finance minister can work on. But speaking of NPS, Kuldeep, your thoughts? Any further changes? Because what we just saw a couple of weeks back, actually, I think end December, was that now the time when you're withdrawing money from NPS, there, things have been made more tax efficient already ahead of the budget. So if you could just revisit those provisions for us.
Yeah, absolutely. Government made the announcement. Actually, they were very interesting announcement. I think that those were the very, good step. In case of the government employees, the government contribution is going to be 14%, as against the, 10% for the private employees, for example, in the private sector. And then the government employees have also been given the choice to invest into the equity-rented proportion as well. And another interesting point was that, if the government employees are investing into the Tier 2 account and with a lock-in period of 3 years, so they will be able to avail the deduction under Section 80C. Now, this announcement is not talking about the private employees. And now, although these were the announcement, but to give them the effect, probably in this budget we will see the changes. And while they will be making these changes, so I think it's a hope, and I think it's expected that the contribution to Tier 2 account for private employees may also be made tax exempt for the private employees. Now, coming on the withdrawal portion, earlier what used to happen at the time of retirement, when you are withdrawing money from the corpus, from the NPS, so 40% you have to compulsorily buy the annuity, and the rest 60% you can take as a lump sum. Out of that 60%, 40% was exempt, and on 20% you used to pay tax on that. Now the government announced that limit of exemption has been raised from 40% to 60%. So now the NPS would be into exempt category. Sure. So I think that NPS is a particular focus because India does not have a social security system in place, and government is pushing very hard to make NPS popular, and it has also now been made available to the private, even to the self-employed individual also. Right. I think government probably will continue that journey, and the focus on this will continue so that lot of individuals join the NPS.
Sure, but as a purist though, if I want to be a little strict, I'd argue that this added deduction of 50,000 should only be given when you are going to remain invested up till retirement. If you will churn that money and remove it after the end of the 3-year lock-in, then really what is the point? It's really not retirement security, that is it. So gentlemen, we have to now talk about an important asset class, and that's real estate, because quite a few changes have happened over the course of the years. I think one of the most, if I could call it, painful changes was when the loss from house property was capped at 2 lakh rupees. So whatever loss you were making, interest costs, etc., you couldn't get more deduction than 2 lakhs. So the argument I think the government was throwing out was they don't want unnecessary speculation, and they don't want to reward people for just going and buying houses and letting them use the entire loss as a deduction. Your thoughts on this, Homi? There's a huge push from the real estate lobby to tweak this, to dilute this further. How do you evaluate this?
Yeah, so this provision was, as you mentioned, should be brought in about 2 years back. And if you have a loss, let's say a loss is 5 lakh rupees from house property, and you've got other heads of income where you're earning income, you can only set it off to the extent of 2 lakh rupees. And the balance amount, let's say 3 lakh rupees, can be carried forward to the subsequent years, but it can only be set off in the subsequent 8 years only against house property income and not against any other income. So
that wouldn't make sense for the same house anyway, because you'd be getting a loss from the same property even in the subsequent year.
That's correct.
And the loss simply being the fact that there is deemed notional rental income versus the interest expenditure that you have, and therefore in typical cases you would arrive at a loss.
Correct. So the question is, will this amount, as you mentioned, the real estate is lobbying to increase, either remove it or to increase it? I think one will have to really wait and watch to the interim budget. Maybe changes may not take place right now because it's an interim budget, and this provision was just brought in a couple of years back.
Exactly. I remember 2 years back.
2 years
it,
back.
It hit the headlines. Kuldeep, your thoughts on housing? Any further tweaks or changes that you might expect? Of course, the self-occupied homeowner would also want, I think, the interest deduction or the interest limits to also go up.
Yeah, actually, one point I wanted to